Hello and welcome back to another episode. Another episode indeed. Hope life is well. Um, it's another cracking day on the Mead Gold Coast, of course, where we the 16th of June. It's a beauty. Hope it is the same where you are. And hope you had a nice weekend. We had a good weekend, busy with fun things mostly. Um, and we had Friday night, actually something I don't do every day of the week. We had a table. I was the quiz master for a table quiz for Laytown and Bettystown Lawn Tennis Club. A bit of a fundraiser, so I was volunteered, shall we say, to do quiz master on the night. About 100 people turn up, and we raised a few bob, and we had great fun. Uh, I thoroughly enjoyed myself. I think it's a calling to be a quizmaster. Not so much in terms of my general knowledge abilities, but in my enjoyment of actually hosting it. I had a ball. We had great fun. I don't know if anyone else enjoyed themselves as long as I did. Isn't that the case? Anyway, moving swiftly on. This week I have I, I got into a topic that has been on my radar for ages, to be honest. I I love looking at this stuff, and I have to be careful when looking at this stuff, um, and talking about it and publishing these types of things. But they, I believe, are hugely important for people because there's so much information out there. There's so many claims to X, Y, and Z. So many adverts, so much marketing, trying to attract people to certain avenues for investment. So this one for me is a biggie, and so I hope it is useful for you. Okay, so straight in, what are we talking about? What's the best ARF fund for my pension, right? And the reason I'm doing this is because when Googling this and researching this, there's lots of course, paid for adverts that pop up. So the first 3 or 4 or 5 results of any search will usually be, financial planning firms, etc. But then once you get past that, you'll come across provider websites and broker websites, that are trying to attract your eyeballs and your clicks, of course. And there's lots of information and lots of different companies being mentioned and lots of different funds being mentioned. And so I said, hey, let's actually compare some of the top results that appear and see, okay, how are these actually performing and how appropriate are they for different people's ARF funds? So, and again, apologies if you need a reminder, an ARF is an approved retirement fund. It is the vehicle, the current vehicle as of June 2025 that is predominantly used. And it's what happens to most of our pensions when we start drawing income from them and we don't choose an annuity. So it's an annuity, or you put your pension assets into an ARF and you draw down a percentage or a certain amount each year and hope that the investment and the underlying funds will perform in such a way that your ARF will outlive you. Ultimately, is what most people seek to achieve. And we've tons of information on that on our website. If you go onto the blog section, you can search by keyword now. So search for ARF, for example, or annuity, and hopefully you'll get some updates there. We did a bit of a refresh on the website actually recently. So you can go onto the blog, and hopefully it's easier to find different topics and different articles because there's a lot there over the last 8 years or whatever it is now. So what is the best ARF fund? First of all, I empathize with people when if they're trying to search for this stuff, because there's so much different information and a lot of it contradictory. One claim an X is better, one claim is Y is better. And so I really empathize with people trying to figure this stuff out for themselves, whether it's they can't or they don't want to engage somebody to help them, or they don't trust them, or they can't find a source of trustworthy information. I absolutely empathize because they're huge decisions, right? You're choosing the investment strategy for what is for many of us our life savings and what will be heavily relying on it by way of income um, in retirement. So it's a big deal. It's really, really important. So one of the names that pops up when you do search best ARF fund in Ireland, um, noted by a couple of websites, is Marion Investments. Marion Multi Asset 70 is another noted on a few prominent websites and spoken very highly of with regards to an ARF fund. Another result is the Mercer Approved Retirement Fund. That's another result that popped up when I searched it most recently. Another site that appears on page one of the search is suggesting Zurich Prisma 5 Fund and New Ireland iFunds 5 S12 to give it its full title as some of the top performing ARF funds as well in Ireland. And then you might read or listen to something from Informed Decisions ourselves or from the US around passive investing and using the likes of Vanguard and BlackRock or whatever fund manager, but that real pure passive approach. How the hell is anyone meant to make head or tail of all these potentially conflicting suggestions and ideas around which is actually best? And I will show the data. I will show the actual performance data and the potential ARF outcomes over the last 10, 11 years in a couple of moments. But first, I just want to talk about what best, that word best, right, when it comes to best ARF fund. I don't know whether it's a modern thing, but people see, and me included, we seem to search for the best the best microwave oven, the best camping chair, the best, I don't know, roof tiles. There's best is a word that an awful lot of people seem to use when looking for things. And I'm not sure that that's the best way to go about things, for want of a better word. Particularly when it comes to something like a best ARF fund, I believe it's subjective, right? What might be best for one person may be worst for another, and vice versa. It all depends on what you need or want from your ARF fund. There's a line I never thought I'd say. What do you really need from your ARF fund? But seriously, there are things to consider here, right? When exploring and choosing an ARF investment strategy, and not a full list. I forget the term there, apologies, but not an exhaustive list here, right? But some things to consider, right? And again, I always recommend getting professional, qualified, insured help for this sort of stuff. But some of the things that I think are worth considering. Time horizon is king. Like, are you seeking maximum long-term growth and performance, or are you looking for a smoother journey? Like, you're investing for 20, potentially 30, potentially 40 years, possibly more. If you're, investing in an ARF at a relatively young age, this thing could be invested for 60 years potentially, right? So your time horizon, your investment horizon is potentially very, very long. It might be advisable not to let short-term noise or concerns or fears or hysteria potentially to upset plans and to really dictate your actions. Know your drawdown needs. How much are you going to need to draw, whether that's income or that's percentage terms or euro terms, gross and net. How much do you need to generate into the future for plan to be sustainable? That should feed into the strategy and the investment strategy and what you're going for and how you invest and what you invest and what funds you choose, what providers you use. That whole piece around diversification. How diversified do you want to be across asset classes? Is it equity? Is it property? Is it bonds? Is it alternatives, commodities, or a combination of those, or one of those? Again, there are things to consider. Costs matter. Fund manager costs, commissions, advisory costs, platform costs, wrapper costs, custody costs. All these things need to be, I believe, clear and understood. Most costs are unavoidable. Not all, but most of the costs that I mentioned there are unavoidable if you want an ARF. But it's to know, okay, what do I need? What do I not need? And what am I paying? Okay, and how does that impact on my overall ability for this thing to work? So risk tolerance versus risk capacity. Now, you'll be asked to complete an investment survey when choosing and designing an ARF and implementing an ARF, but the replies that you give, if they are totally dictating the investment strategy, is that correct? Does that conflict with your plan and your income need and your strategy and your preferences? All needs to be factored in. The investment philosophy, is it active or passive? That need to feed in. The provider strength and the support that you get and the service that you get. This is important. Will the provider be around in 20 or 40 years? And I'm not trying to fearmonger there, but what happens in the event of catastrophe, right? And again, nobody's predicting catastrophe, but again, these are potential life savings. That's an important thing to ask and to know, well, in that worst case scenario, this is what would happen. And if that satisfies you, then great, but ask the question. But also then in terms of the support and the service that you get, what do you need? What do you want? And will they be able to deliver it? Unfortunately, the reality is that the service levels from many of the well-established providers, and this is well known, has gone downhill dramatically. Very, very long waits for replies to email, like a week or two to get a reply to a question, long waits on phones, being put on hold for long periods of time, etc., and mistakes and errors happening. That's something, again, if that's okay with you, then fine. But understand what you're getting into, I would think, because that's a massive cause of frustration and potential loss, depending on what the extent of it is. Income sustainability. How sustainable is this plan and this strategy and this fund and this approach? What happens if there's a bad sequence of returns, right? How would that potentially impact on your plan and what you're intending to invest in? The tax strategy, I mentioned gross income earlier on. Most likely your retirement income will be taxed. So super important, I believe, to understand what is your net income. If I'm taking X% per year or X amount of gross income, what will that net down to based on my other incomes and based on my overall tax rate? What's this potentially going to look like? Massively important, right? But again, how many people give that consideration? And then review and rebalance. Is this something you want to review? Do you want to look at the investment strategy on an ongoing basis? Do you want to look at the drawdown strategy and what aspects of the portfolio you're drawing income from? And does that need to be tweaked in various scenarios? I'm not trying to overcomplicate it, but I guess ultimately these are things that I believe should be factored in because they're bleeding important considerations. This is an important aspect. In my experience, many people want to achieve the best possible returns over the long term without taking unnecessary risk, right? It's that kind of balance. I want the pot to generate the income that we need and for the pot to remain largely intact if possible over the future. That's, again, what I commonly see. And perhaps the ARF holders and the people that seek our help here at Informed Decisions, they understand our philosophy and our approach to long-term investing. Maybe it's self-selective, but many, I'm sure, prefer to have a smoothed journey, a low volatility, smooth journey. So, hey, I don't have the capacity nor the desire to be thinking or worrying about what's happened in markets, etc. I just want the income and the story. And maybe annuity is the right thing for you, or maybe you're choosing an ARF for another reason. Okay. Again, it's down to the personal individual is the point. Best is an individual thing. Just like personal finance, it is personal. Okay. So what is the best performing ARF fund in Ireland as of June 2025? As I mentioned earlier on, when you Google best ARF in Ireland, there's several results that pop up on page one, and I've picked those only. This is a very, very small sample. This is not comparing anything with anything. This is just showing those that pop up, which is what people are most likely to see if they are Googling and searching for this stuff. This is what is being put in front of them, rightly or wrongly. And I'm going to show performance data, and you decide whatever you decide about whether it's good, bad, or indifferent from you. So the following funds to assess, which I have done in FE Analytics, performance software, which we pay a lot of money for every year to use and to have this ability for our clients. So the funds are from some of Ireland's insurance companies. So New Ireland, Zurich, Merian, and Mercer. And for comparison, I also included an 80/20 globally diversified equity bond index from Vanguard and iShares, and 100% passive equity global portfolio from Vanguard iShares. So the list are of the funds: Merian Investments Equity Fund, Merian Multi-Asset 70 Fund, Mercer Approved Retirement Fund, Zurich Prisma 5, the 80/20 Vanguard iShares portfolio, and 100% equity Vanguard/iShares portfolio. And we could go back to 2014 only because one of those insurance company funds is only around since 2014. So we'd have to exclude it to go back further, which we could do, but we kept it to 2014 so that we keep all the listed and promoted and suggested and implied funds on the analysis. So this is a total returns. I'm really building this up. This is a total returns, which is not the complete picture. This is showing, okay, if you'd, what was the percentage return of each of these funds and portfolios since inception date in March 2014. Okay, so this is not the total picture. It's a modeling in ARF, but for now, I'm going to show you the total returns. This is a small sample, as I said. Drum roll, please. No drum roll. Okay. No surprises. The 100% passive equity fund was well ahead of all others at 221% for the just over 11 years. That followed by the 80/20 passive equity bond portfolio at 181% total return. Next up was Zurich Prisma 5, 179%, followed by Merian Multi-Asset 70, 164%. iFunds 5, beg your pardon, New Ireland iFunds 5 at 137%. Merian Global Equity Fund 117%, and Mercer Aspire Retire Fund ARF 63%. So we've had a broad range there from 221% with an all-out passive equity approach to 63.13% from Mercer Aspire Retire Fund as of Friday, 13th of June 2025. So one might deduct, if all out total returns is what you're gunning for and that's your priority, sacrificing the smooth journey, etc., that might be offered by a lower volatility fund, one might deduct that the 100% equity portfolio there may have been the best over the past 11 years. Perhaps. But if one's priority was less ups and downs, then perhaps the Mercer Aspire Fund may have been best here. Do you see what I mean? It just depends, because if you look at the line chart, if you go to the blog, or if you are watching this, then let me show you. Yes, I'm going to show you, dear listener. Hopefully, I'm opening the right one. Not really. I'll show you the right one now in a second. You think you'd be more organized, wouldn't you? Bloody hell. That's disgrace. Okay, here we go. You can see, right? If you're watching this, you can see the smoother journey. That's the Mercer Aspire Retire Fund, right? 63%. It had marginal ups and downs, but like you're talking about a swing of a couple of percent, whereas you have swings here on the 100% equity of 20% almost, right? This year alone. So that's a very, very different journey to that smoothed returns. It has delivered lower total returns in that period of time, but it has been smoother. So again, it just depends on what your priority is. That's the point. That is my point. Okay. But what if you're drawing down income every month, which most people will be doing from an ARF, right? And you have to draw income from an ARF from the year in which you turn 61. So if you have an ARF and you're in your 50s now, You can choose to take income from it, but you're not obliged to. All right. So if you're in your 50s and you have an ARF, it may or may not make sense from a financial planning and sustainability, etc., perspective to be drawing some income every year from that ARF, depending on what else is going on in your world. But once you turn 60, ultimately 61, you have to draw minimum 4% from that ARF. So what happens? How would the last 11 years and those funds have performed and delivered for different scenarios over the last 11 years? And so what I've done here, and I love this, I've modeled that you had €1,000,000 in that ARF in March 2014, and I've modeled that you drew 5% gross per year, paid monthly. Okay, so it's actually kicking out 0.43% monthly is reality what's happening. So to paint the picture, in March 2014, month one, your portfolio is worth $1,000,000. 5% of that is 50,000 gross per year. And in month one, given that the value hadn't changed, your first monthly gross income was 4,166, right? Now, importantly, we model that you're taking 5% per year. The way that the vast majority of insurance companies will default to if you're drawing income is they'll just send you 5% of the value of the pot in any one year. So if the pot falls in value, you got less. If it rose in value, you got more. You get me? Okay, so it's not a set income as such. I'm not saying that this is the best approach in terms of income drawdown from an ARF, but it is how the insurance companies tend to operate. Okay. Now let me deliver the results of this particular outcome. Best ARF. What is the best ARF? But here is how the outcomes were over those 11 years. The 100% equity portfolio, $1,000,000 in, drawing 5% of the pot each year, gross. Your $1,000,000 is now worth 1.8 million. Yes, correct. And bearing in mind that we have experienced massive market corrections and declines in 2020, 2022, again, 2025, like really significant 20-30% declines in those years. It's probably quite surprising to think that I've been drawing 5% a year from the $1,000,000 and it's now worth 1.8. Yes, this is the reality. This is how it has panned out. We don't know if that's how it'll be for the next 11 years, of course, and that's the challenge, but that is how it has delivered. And, who provided that they could withstand the market swings wouldn't be happy with that particular outcome. So 100% global equity portfolio Vanguard iShares as modeled, 1.8 million. The 80-20 Vanguard iShares portfolio next in line at 1.58 million. The Zurich Prisma 5, 1.54 million. So that's a heavily equity-based fund. The Aviva Merian Multi-Asset 70, 1.45 million. Merian Global Equity, 1.35 million. New Ireland iFunds 5, 1.32 million. And the Mercer Aspire Retire Fund, 913,000, which is just a margin, a smidgen under half of what the 100% passive global equity fund is currently, which is interesting. So, in summary, which really is the best ARF fund, in Ireland as of 2025? The answer is, I don't know. I know what I would pick. If I were drawing from an ARF today, and I know what I recommend most people who can withstand things, what I recommend they do. but I don't know what's right for you. And that's why I think it's really interesting to look at this. Here's the numbers, but here has been the journey. So, what is your priority? Going back to those considerations that I outlined earlier, it really does depend. It really, really does depend. Um, yeah, many people that I speak to and have spoken to over the years have a sense that they should be able to. This is how they would phrase it. I should be able to invest this ARF, draw an income, and still have the pot left over when I'm done with it, right? When I move on. And that's kind of a sense that people have. And we can see over the last 11 years, that's been very, very achievable in pretty much every kind of fund that and this is a tiny sample, that we've looked at there. We're not saying one is particularly good or one is particularly bad. It just depends on what the outcome you've been seeking has been. And I hope that this helps. At least in terms of showing you the practical outcomes of, hey, if you have had an ARF for the last 11 years, I know that's a very specific time frame and case, but they're the kind of outcomes that we have seen, and hopefully they're the kind of outcomes that we can expect going forward. And I think again it goes back to knowing what you want and what you need from your ARF, and then act accordingly. And please do it with professional guidance. What I'm talking about here is neither investment strategy, tax, nor ARF drawdown advice. It's just showing you some numbers, but I hope it's information that proves useful to you. Please do your own research, but by God, there's no doubt about it. People who have been invested anyway properly over the last decades ultimately have done extremely well, and they've had to withstand some tough times, of course, but they've done extremely well. And I hope that we will all continue to do extremely well. And you've done very well indeed, dear listener, to make it this far. So thank you. I do hope it has helped. As always, you're a legend.